G'day, I'm Bryce Robertson, principal here at Cultiv8 Collective, and welcome to the Cultiv8 Collective Inner Circle introductory webinar. Here at Cultiv8 Collective, we help passive investors create financial freedom and expand their wealth through recession-resistant investments. So by now, you should have received an invite to schedule a call with somebody on our team so that you can have a quick discussion before joining our inner circle. Obviously, watching this webinar first, but I wanted to just bring up that when you do get on that call with us, that we're going to be asking you about your investing background. And we're also going to ask a couple of other questions to get to know you a little bit better. And the reason this webinar has actually been put together is for you to get to know us a little bit better, get to know me as your webinar host here and principal at Cultiv8 Collective, and also understand our team and where we see the opportunity in the market today and how we operate and how we could help you achieve your financial and freedom goals. And so while you're watching this webinar, I just wanted to point out that if you have any questions that come up, just jot them down on a piece of paper or keep them on your computer somewhere. And then when you do jump on a call with somebody on our team, then that is the perfect time to get those questions answered. We're here to answer any questions you got. We also feel pretty confident that we're going to answer most of those questions in this webinar. So let's dig in. So before we dig into Cultiv8 Collective, I'm just going to bring you up to pace with me, Bryce Robertson, your host and principal here at Cultiv8 Collective, and just share a little bit on my story and why I'm qualified to be speaking to you today. So my name is Bryce Robertson, born and raised in Brisbane, Australia. I got to near the end of high school, and then I realized I am not going to university. I just wasn't connected with the schooling system. I wanted to go out there and make money straight away. But at the time, interestingly, I didn't have any business or entrepreneurial influences. It just wasn't in my life yet. So I went out there and got the highest paying blue collar job that I could find and received an apprenticeship as a steel fabricator welder. So I completed a 5-year apprenticeship in about 3.5 years because I was extremely motivated. And then I went and moved from Brisbane out to Western Australia so that I could work in the underground gold mines, which was where I could earn the big bucks per se as a blue collared worker. And so and out in the gold mines, I was working 12 to 14 hours a day, 7 days a week, 8 weeks on, 1 week off. And I did that for about 2 years in Western Australia and Northern Territory. And that enabled me in my early 20s to save up a pretty decent chunk of cash, enough so that I could embark on an adventure that I'd been dreaming for most of my life, which was to travel the world for 6 years. And so in my early 20s, I embarked on that journey, and I first went to London to set up my base camp because that's where I would work and earn my money. And so I set myself up there, and I would work 8 to 10 hours a day, 5 to 7 days a week for 3, 4, 5 months at a time. And I'd save up a little chunk of cash. And then I would go traveling through Europe until, you guessed it, until my money ran out. And then I would come back and work again and go to Africa. And I did this whole UK, Europe, and Africa cycle for 3 years. Then after that, I wanted to change the scenery. So I went from 12 million people in London to 5,000 people in a really small ski village called Fernie in British Columbia, Canada, because I wanted to have an experience of living in the snow in the mountains and experiencing a snowboarding season. So I did that. But after being there for a couple of months, I realized I really, really loved the area, so much so that I wanted to stay there for a while. And at the same time, I found out that there was coal mines just down the road. So I started my own gig out at the coal mines, and I ended up staying there for 2 years. And when I wasn't working in the coal mines, I was firefighting downhill mountain biking, snowboarding, or enjoying some kind of outdoor mountainous activities. And I was so enthralled with what I was doing there that I ended up staying there for 2 years and I didn't really travel anywhere. So that enabled me to save an even bigger chunk of cash this time so I could go on an 18-month surfing and scuba diving tour down in Central and South America. And when I was on that 18-month surfing and scuba diving tour, in the last 6 months, that's when I met the love of my life, my wife, who is a native from California. So naturally, I gravitated towards here, the United States. And that was back about 12, 13 years ago. And so I proudly love living here now. This is what I call home. I'm an American citizen. But interestingly, when I first got to the States, my wife and I made a commitment with each other that we wanted to recreate this type of freedom lifestyle that we'd been living, except this time, number one, we wanted to do it without our money running out. And number two, with our money actually growing and expanding and cultivating as we're traveling and enjoying the life and the freedom we constructed it that way. So we went out and we looked at the 3 main ways to make big bucks. That's owning a business, real estate, and the stock market. And I believe these days, cryptocurrencies fits in the stock market category, but back 12, 13 years ago, it really wasn't a thing. So looking at those 3 categories, I went out and tried about 7 different side hustles. I was just trying everything to see what would stick. And then after a while, as you probably guessed, I realized I was spread too thin. I was having mediocre success. I was spreading my energy out into too many different things, and I was spinning plates. I realized I needed to take a breath, take a step back, and then decide to laser focus on one thing and put all of my energy into that one thing. Now, I knew it was going to be real estate because at the time, I had a 17-year background in construction and construction management. But what was I going to do in real estate? Well, I looked at all the different ways to make money in real estate: single family homes, fix and flips, wholesaling, notes, multifamily apartments, self-storage, mobile home parks, the whole kit and caboodle, you name it. I was looking at it. And over and over and over again, mobile home parks kept popping off the page. Massive supply and demand for mobile home park owners, in favor of mobile home park owners, getting to solve what I believe is America's #1 real estate problem, and that's the need for affordable housing. Awesome tax benefits, high cash flow, great returns, very little competition, and I was all in. So when I made the decision to be all in, 3 months later, I put my first mobile home park under contract. But interestingly, at the time, I didn't have the situation to get that deal completed by myself because I had a negative net worth, $2,000 in the bank, and unseasoned credit. So by nature of my circumstances, I had to go out and lean on family and friends to bring in the capital to fund the down payment of the loan and the closing costs. And in addition to that, I had to go out and creatively structure some type of private financing so I could get this deal across the finish line. And we did exactly that. I went out, I attracted a couple of friends to join the investment, and then created a creative financing structure with somebody who was providing a note through their retirement account, and ended up 3 months later getting the deal done and getting the deal across the finish line. And when that happened, I realized that there's this massive demand for investors to join investments where I'm doing most of the heavy lifting, if not all of the heavy lifting. And in our space, we call that the syndication model. So I ended up rinsing and repeating syndication for the next 2.5 years, and then created financial freedom. And when I became financially free, I became really, really compelled to share my story with other people, because I looked at the 20 years at that point that I experienced in the construction industry. I didn't really like the way I positioned myself. I wasn't really satisfied with what I was doing. I knew that there was a bigger purpose for me in my life, and I really didn't have anything to show for at the end of it. As compared to then when I spent 2.5 years investing in real estate, absolutely loved what I was doing, created financial freedom, totally turned my life around and created abundance. And I became really, really compared to share that story with other people so they could go out and recreate their version of my experience. And in that process, a lot of these brands were born. In the beginning, my first company was Property Works. That was the first company that took me a very long way and helped me attract a lot of investors and helped out a lot of investors along the process. But then in 2020, I brought on Nolan Freeland, who is now my business partner. He was actually a mentee student of mine. I was his mentor for 2 years. And then we finally decided to join and go into business together. And that's when we created Cultiv8 Collective, who is actually presenting this experience to you today. And that's our main company and our main brand that we host all of our investments under. And that's where we have our assets under management. Also in 2020, I created Freedom Hack Radio, where we explore the freedom trinity of financial, time, and location freedom. We also weave in there a little bit on health, wealth, relationships, spirituality, and having fun. And I have leading experts in each of those categories. Join me on Freedom Hack Radio to have some really juicy discussions to help people achieve more freedom in their life. And I also created my own personal brand along the way. So again, I went from a negative net worth and $2,000 in the bank to unseasoned credit to financial freedom in 2.5 years. And since then, I've been featured on Fox, NBC, Bigger Pockets, CBS, USA Today. I've also shared the stage with people of the likes of Ken McElroy, Russell Gray, Sharon Shrivastava, Michael Eden, Neil Bawa, Gillian Hellman, Jesse Ecker, Jay Massey, Matty J, and Bruce Norris, to name a few. And on Freedom Hack Radio, I've had the honor of having such guests on my podcast as Sharon Lecter, John Gray, David Morgan, Bob Burnett, Lynette Zhang, Jerry Robertson, Justin Roethlingshofer, and Hunter Thompson, to name a few. I'm also a best-selling author. I actually co-authored this book with 7 other Aussies. Collectively, we're called Real Estate Mates, and we wrote 10,000 Miles to the American Dream, which is our journey of financial freedom. And also, I'm host to Financial Freedom Mastery, a 2-day intensive course where we help people achieve financial freedom or create their goals and exact path based off their specific circumstances, needs, and goals, because nobody's in the same place. I'm also host to A to Z of MHPs, a 2-day mobile home park investing course. Also co-host to Raising Capital Like a Pro, a 2-day capital raising course. I write articles for Bigger Pockets. I've guest appeared on hundreds of podcasts, and our Inner Circle investment group has directly invested in over $250 million worth of recession-resistant investments. My lifestyle philosophy is living by the freedom trinity of financial, time, and location freedom. And the reason that I mention this is because so many of us are coming here wanting to watch this webinar, wanting to join our inner circle because they want to create more abundance in the financial piece. They want to create financial freedom, or if they already have, they want to expand on that and create more wealth. But the interesting thing is behind that, most of us actually want to get that financial piece taken care of so that we can have more time freedom in our life. When you jump on the investor introductory call with me or somebody else on our team, one of the questions we're going to ask you is, what's your big motivating reason why behind your goals for financial goals that have nothing to do with money? Because there's a big motivator behind all of it. And it usually has something to do with how we're going to spend our money or how we're going to spend our time. And to be honest, I would say that about 70 to 80% of investors in our inner circle have a massive drive to expand or create time freedom in their life. And then me personally, I like to go the extra step and also have the location freedom as well, so I can live the lifestyle of freedom, spending my time the way that I want to spend it from a location wherever I want to be all over the world. And so that's the freedom trinity right there. So what we're going to cover today is who this is for, the inner circle, who's that for, challenges from the world of passive investing. We're also going to talk about the Cultiv8 Collective experience. We're going to introduce you to our investment philosophy. And we're going to talk about our core focus. We're going to go over our recession-resistant investments and recession-resistant investing. We're going to talk about gold rush investing, performance-based deal structuring, minimum investor return metrics, our recession-resistant underwriting and deal structuring, our minimal fees so that we can maximize returns. You get to meet our team. You get to understand our geographical footprint. And you're going to learn about our unique advantage and our unique positioning in the market. We're also going to go over some deal examples, and then we're going to talk about next steps. So quick disclaimer before we get into this: I'm not a financial advisor. I'm not a CPA. I'm not an attorney. This is here for educational purposes only. It's up to you, the investor, to make your own investment decisions. And if you want to lean and get some financial advice, it's up to you to lean on your own financial advisors, CPAs, attorneys, because only they can advise you on your specific needs, goals, and circumstances. So, who is the Cultiv8 Collective inner circle for? So, it's for you if you are an accredited or sophisticated investor. We do 506B investments and 506C investments. 506B, we typically are allowed to have up to 35 sophisticated investors and unlimited accredited investors. And 506C investments, we can have unlimited accredited investors only. This is also for you if you're seeking recession-resistant investments. It's also for you if you don't have the time to find, put together, and manage investments. It's for you if you don't have the resources to find, put together, and manage investments. Our inner circle is for you if you're tired of being presented the same old stocks, bonds, and mutual funds theory. And honestly, if you're tired of being presented the same old boring real estate investments. We really, truly do have a unique positioning in the market, which you're going to find out as this webinar unfolds. So this is truly a unique experience. Our inner circle is for you also if you're wanting to work with some of the top operators in the US, and if you're wanting access to top shelf, off-market, recession-resistant investments. So let's talk a little bit about challenges we can experience from the world of passive investing. Here's some of those challenges: lack of transparency from principals and operators, inaccurate communication and reporting, hard to get hold of the principals or operators, speculative projections that often and sometimes can't be met, delays on distributions, taxes late every year, and sleepless nights while you're investing. The Cultiv8 Collective experience is a unique experience. The Cultiv8 Collective experience is full transparency. We tell you the good, the bad, and the ugly. We're fully transparent. We don't hold anything back because being authentic and honest is the only way to be. We're in this for the long term, so we're totally transparent. Also, we provide monthly and or quarterly communication through detailed reports and financials. We provide access to video calls, emails, and phone calls with me or Nolan, the principals of Cultiv8 Collective. We provide the most conservative underwriting of mobile home park or self-storage operators that we know of. And I honestly challenge you to find us another operator that seriously has as conservative underwriting as us. You will understand why as this webinar unfolds and we talk about our recession-resistant underwriting. We provide on-time distributions, tax forms on time. Yes, we are subject to our JV partners, but we do everything within our power to get everything over to you as soon as possible. And this leaves you in a position of having peace of mind, knowing that you're in excellent hands. So let's talk about Cultiv8 Collective investment philosophy. Here at Cultiv8 Collective, we help passive investors create financial freedom and expand their wealth through recession-resistant investments because we believe our investments should perform well during good economic times and even better during down economic times. Our core focus is mobile home parks and self-storage. That's our main bread and butter. That is what we specialize in. We have our own in-house property management company, Innovate Collective. We have our own in-house asset management company, which also represents our assets under management, which is Cultiv8 Collective. We have our own in-house construction crews. I have a 25-year plus background in construction and construction management. And we buy a lot of heavy value add mobile home park and self-storage opportunities. And we have an exceptionally quick business plan implementation where we turn around parks and increase them to 100% occupancy in a really short period of time. This is our main bread and butter. This is what we specialize in. Having that said, joining the Cultiv8 Collective inner circle doesn't limit you to just this. We also provide what we call a smorgasbord of recession-resistant investments. Now, let me clarify here. We only specialize as operators in mobile home parks and self-storage. We don't claim to be experts at anything else. So what we do is we go out there and we team up with the best of the best top operators in these different alternative asset classes. We team up with them, and so that we can bring our investment group to the table to be able to join this smorgasbord of recession-resistant investments. And our operating partners that we join up with, who are the best at what they do, they take care of all of the heavy lifting because they specialize in each of these asset classes. Some of these asset classes that we've brought to the table so far is automatic telemachine investments have been extremely successful. All of the distributions have been met on time every single time. And we have teamed up with the 4th top ATM operator in the US. Really excellent experience they've had with our ATM investments. We've also brought to the table some multifamily apartment investments with some of the top multifamily apartment operators in the US. We're currently where we are economically a little bit wary of multifamily apartments. We believe that most of them don't really fit our recession-resistant model. So we're not very heavy on them right now. But depending on when you're actually watching this webinar, that may change if we believe we're going to bring to the table a specifically recession-resistant multifamily apartment investment. But we have had a lot of success with these in the past, and we're definitely open to bringing them on when we feel the timing is right, or if that specific investment fits our recession-resistant model. We're also heavily involved in the Bitcoin mining space. We have teamed up with one of the best Bitcoin mining operators in the US. I think collectively right now, we're part of about 55 million of Bitcoin mining operations. And we're spread out in the New York area, and we're also spread out in the Texas area as well. We're also backed by natural resources, and we've had a lot of success in the Bitcoin mining space. We've also teamed up with another operator who was the consultant to the El Salvadorian government and financial system when El Salvador decided to bring on Bitcoin as legal tender. And so we've teamed up with him to bring some more Bitcoin mining investments to the table. So we're actually spread out across a few different operators in that space. And depending on when you're watching this webinar, we're expecting to be bringing more Bitcoin mining operations and investments to the table. We're also on the precipice of bringing, as of this webinar, on the precipice of bringing some Bitcoin telemachine investments. That's Bitcoin ATMs to the table with the #1 Bitcoin telemachine operator in the US. So keep an eye out for that. Again, based on the timing, we may already be bringing these to the table depending on when you're watching this webinar. We're also teamed up with one of the top car wash operators in the US. So keep an eye out for some car wash investments coming your way. It's an extremely untapped market. The top operator, or the largest operator in the car wash space in America as of today, only has 350 car washes. This is a very, very, very unique space, and we expect to bring a handful of car wash opportunities to the table in the near future. And there's one bit of bottom picture down this bottom right corner. It's not exactly the perfect representation of what it is, but it was the best picture that we could find. And it's actually representing refrigerated storage. In actual fact, refrigerated storage is like a big warehouse that you can drive forklifts around in and pick up products on pallets. The whole room is refrigerated. It's not a little container like this, but we are going to be bringing to the table some refrigerated storage investments, because that's also a very underutilized and untapped space. All of these investments, we believe, bring to the table recession resistance, especially with the operators and the business models that we bring to the table on these investments. But again, I want to give you some peace of mind knowing that we only specialize in mobile home parks and self-storage. Our operating partners specialize in each of these asset classes, so we can bring to the table top shelf recession resistant investments with top shelf operators. Gold rush phase investing is an approach that we have when we're looking at our investments. I'm sure you can understand and visualize what a gold rush phase investment is. It's something where we're either in the early, beginning, middle, or end stages of the gold rush phase. And in the beginning of a gold rush phase, there's massive profits to be made. It's highly unregulated. It's a very untapped space. There's hardly that much competition, and there's just a lot of opportunity. And then as a little bit of popularity builds in that particular investment, whatever it may be, more people join in, a little bit more regulation joins in, the profits start to dwindle a little bit, but they're still very abundant. And that would be about the middle stage of the gold rush investing. And then the latter stages of gold rush investing is when the word has got out, a lot more people are doing it, but there's still a lot of room for people to join. Regulations tightened up a little bit, but there's still a certain amount of regulation that's open. And we like to have our investments fall somewhere in the gold rush phase of investing, or the business model that we have in that asset class fall in some type of gold rush phase investing, because we believe that's where the biggest opportunity exists. And when we mash gold rush phase investing with recession resistance, with recession resistant investments and top performing operators, we believe we have an excellent recipe. And that's why we have 100% track record of exceeding our projections on the investments that we've been bringing to the table that we've gone full cycle on. And we have performance-based deal structuring. So many operators and investments out there, they will make money off the investment regardless of its performance. Whether the investment goes up or down, those operators or investment managers or fund managers will make profits regardless of the performance of the investment. We are the complete entire opposite of that, so much so that we really don't make much money at all until we've delivered on what we said we are going to do. So I'm going to introduce to you two different types of deal structuring that we typically bring to the table. And now I'm bringing the conversation just back to mobile home parks and self-storage, because I'm talking about us as operators. This is our bread and butter. This is what we specialize in. So the deal structure number one in the mobile home park and self-storage space of investments we bring to the table is with no refinance. And we're typically buying our properties at 70% occupied or more. We get an acquisition loan that's typically 30% down. We bring in all of the capital needed for our capital improvements to implement our business plan and bring the occupancy to 100%. We bring in all the capital for the closing costs and the down payment for that acquisition loan. And then our typical deal structure with this for our investor returns is investors typically receive an 8% preferred return. So that means, for round numbers, if investors invest $100,000 in this type of investment, then they would receive $8,000 annually as their preferred return. We actually pay that out quarterly. So it would be $2,000 or 2% paid on a quarterly basis, which would equal 8% annually. And then after that, in that same year, any excess cash flow beyond that is split. 70% goes to investors and 30% goes to me and my partners, the general partnership. Then after that, if that investment is performing to the point where investors have reached or exceeded 12% of annual cash flow returns, at that point, we have what in our space we call a waterfall, which goes to a 50-50 split. 50% of excess cash flow beyond 12% annually goes to investors, and 50% goes to me and my partners, the general partnership. And then also at the sale event, at the end of the business cycle, which is typically about 5 years, we would split the proceeds of the sale. 70% goes to LPs, limited partners, investors. 30% goes to GPs, general partnership, me and my partners. So let me just reiterate that again. So out of all of the cash, the revenue comes in, expenses go out, and the cash flow that's left over, the first cash flow goes to making up that 8% preferred return for investors. Then we do a 70-30 split. 70% goes to investors, 30% to me and my partners. And then once we reach an annual 12% for investors, then we split cash flow 50-50, 50% to investors, 50% to general partners. And then proceeds from the sale get split. 70% goes to investors, 30% goes to the general partnership. And one thing that I would like to add in here before we move on is that we also do cost segregations to maximize our tax benefits and front load our tax benefits into year one, because that's the best tax position we could put ourselves in. And so whenever we're stating our returns, none of these returns include the awesome abundance of the benefits that we can achieve from those cost segregations that we do at all of our mobile home park and self-storage properties. So deal structure number 2 with a refinance. Now, currently, as of recording this webinar, we're entering into a recessionary period. Even whether the powers that be will actually admit that or not, we're definitely in a recessionary type environment. Now, we've figured out to position ourselves with a really, really unique positioning in the market with this type of deal structure. And in this type of deal structure, we're buying our mobile home park and self-storage facilities at about 50% occupied. Okay, so they're about half occupied. So again, we're bringing in all of the capital needed for the capital improvements to bring that up to about 80 to 100% occupied. We're bringing in the capital for all of the closing costs for the acquisition loan and the down payment for the acquisition loan. We also have a similar structure in the beginning here where revenue comes in, expenses go out, and the first portion of cash flow goes to making up the 8% preferred return for investors. And we do that all the way up until the finance. So an 8% preferred return up until the refinance. But what if we make more than 8% in each year leading up to that refinance? Well, in this time, instead of splitting it 70-30, we provide 100% of excess cash flow to investors up until the refinance. Why do we do this? Because we're performance-based operators. We believe so strong-heartedly, so confidently in that we can deliver on our projections that we put our money where our mouth is, and we give 100% of cash flow to investors until we get to that refinance point. Because at that refinance point, we have delivered on our promise. We have done what we said we were going to do. And then at that point, I believe we deserve to then also join in on the compensations as well. So at the refinance point timeline, which is typically somewhere between 12 to 36 months into the business cycle, we project with this deal structure to return original capital to investors at refinance. So let me just dig into this real quickly. So if an investor invests $100,000 for round numbers, they'd be getting an 8% preferred return. So that would be $8,000 a year paid quarterly, $2,000 quarterly. And then any excess cash flow that's made up until the refinance would get paid to the investor as well, plus the tax benefits from the cost segregation. And then when we get to the refinance, we're projecting to return that $100,000 back to the investor, so they can go out and reinvest that capital in some other deal, whatever deal that gets their heart going, whether it's a deal with another operator, whether it's another one of our deals, whatever they choose to invest in. But they get to remain in the deal with us for the whole remainder of the life cycle, which in this deal structure is typically 5 to 7 years. So received all of that cash flow up to that point, go get to reinvest your capital in another deal and compound your returns, but then stay in this deal. And then after the refinance, we do a 50% split on cash flow. So 50% of any cash flow beyond the refinance goes to investors, 50% goes to the general partnership. And then we do the same thing with the proceeds from the sale. 50% goes to LP investors, 50% goes to GP, the general partnership. So that's our second deal structure. And this deal structure, we're actually doing a lot of these in the last 2 years. And most of our investments we've brought to the table has been this deal structure. And as you could probably imagine, these have been extremely popular. A lot of people have been joining our inner circle because of these investments specifically. And some of these investments have actually filled with investors in the first couple of hours because they're so popular, because so many people want this type of quick return of capital so they can go reinvest it in something else, then stay in the deal and compound returns and get to stay in this for the full life cycle. So minimum projected return metrics. So We just talked about the two different types of deal structures that we have. Okay. One with when we do no refinance, and then one when we have a refinance. So I'm going to talk quickly about what our minimum projected return metrics would be for structure number one, where we have no refinance. Okay. That's when we get an acquisition loan. We hold it for about 5 years. And that's the deal structure. So for those, we typically bring to the table investments that have an equity multiple of 2 times within a 5-year period. And that's not including the tax benefits. Okay. Oftentimes we can exceed that metric, but we try and make this our minimum metric. And if we don't meet it, we're going to be extremely close to it. Our IRRs are typically, we don't bring an investment of this type to the table unless it's 15% or more. But honestly, typically those types of investments really bring to the table an 18% plus. And then when we do the deal that actually has the refinance in it, because we're returning the capital so quickly, it cranks up the IRR, and our IRRs for those have brought to the table have been a minimum of 50%, but in often cases, they're about 55 to 60, maybe even 65 or above, because that return of capital is happening so quickly, it increases exponentially the internal rate of return. And then for both of those deal structures, we offer 8% preferred return year one. And distributions typically happen about 6 weeks after the first full quarter of operations. So if you joined an investment, for example, in December, then the investment closes, and the investment closes in December. Well, the first full quarter of operations would be January, February, and March. 6 weeks after that first full quarter of operations is typically where we pay the first distribution. So that would be January, February, March, April. That would be halfway through May, about May 15th, or before May 15th, we would pay the first distribution, and then we'd be paying it out every quarter. So about 3 months after that, until the end of the deal cycle. They're our minimum projected return metrics of investments that we're bringing to the table. Now, let's talk about our recession-resistant underwriting. So not only do we have a unique position where we go out and we buy 50% occupied mobile home parks and self-storage facilities, which is something that not many other people are doing in the space. Again, we have our own in-house property management company, own in-house asset management company, our own in-house construction crews. I've got a 25-year plus background in construction and construction management. So we easily execute on these 50% occupied properties. But another thing we bring to the table to collectively expand on our uniqueness is truly recession resistant underwriting. Now, so many operators out there say, hey, we're recession resistant. We're recession resistant investors. We have recession resistant underwriting. But I actually call bluff, and I say that most people out there really are not recession resistant. And when I show you our metrics on the types of characteristics that we bring to the table to put together our projections for our investment returns, you will understand why we truly are recession resistant. And again, I said this earlier, I would challenge you to go out there, find me another mobile home park and self-storage operator, another multifamily apartment, or any other operator for that fact, that actually has recession-resistant underwriting as strongly as we do. Okay, here's the metrics that we bring to the table when we are doing our underwriting and we are putting together our return projections. When we're putting those calculations together, these are all of the assumptions that we have behind all of that. So, number one, if we are going to do a refinance in the business model, and typically we do our refinances about 12 to 36 months into the business model, and we can get an interest rate on the acquisition of 6%, then we're going to add up to 3%. Typically, it'll be 2 to 3% onto the acquisition interest rate that we get right now. for the refinance interest rate to build in for interest rates increasing between now until we do the refi, which would be 12 to 36 months from now. So if we can get a 6% interest rate on the acquisition, we're going to add, depending on where we're going to be in doing the refi in the 12 to 36 months, it's either going to be a 8% to 9% interest rate at the refinance. That's what's going to be built into our back-end calculations when we're projecting our returns. And again, we do that to build in to hedge against inflating interest rates, which, if you're watching this webinar right now, it's already been happening. We've been predicting this far before it even started happening. We also add up to 3% to our current cap rate for our 60-month exit. So what do I mean there? So if we're buying a property right now and we can buy that property for a 5% cap rate right now in today's market, when we go to exit in 5 years from now, we're projecting that our exit cap rate is going to be an additional 3%. So that would be 8% cap rate on exit. Go out and find me another operator that's actually doing that in any investment. We don't know of any. We do that because when interest rates increase historically, because I study macroeconomics, and that's why I'm so serious and so involved in this recession-resistant outlook, because I understand what's really happening behind the scenes. I understand how our financial markets work and how the whole macroeconomic landscape works. And historically, when interest rates increase, cap rates, there'll be a lag, but cap rates will increase as well. They may not increase exactly on par, but they typically increase to some capacity. So if we're saying that interest rates could increase up to 3%, we're also saying that cap rates could increase up to 3% during our hold period. And so we add on 3% to the current cap rate for our exit cap. In a lot of circumstances, we're actually doubling our construction costs. We do this because price inflation, you've been seeing that happen. You're seeing that now, or if you're watching this a little bit in the future, you've been seeing it happen in the past. But construction costs are increasing. So sometimes we even double our construction costs. We add in a lot extra because things can go wrong. Supply chain issues could happen. We may not even be able to get some of the materials that we're looking for, and then we might have to go out and get some alternative types of materials to get the job done. But even while we double out a lot of our construction costs, what we do is as soon as we close on the property, we go out and we buy bulk materials. So we buy in advance to hedge against any future inflation that could happen during the business cycle. And that also gives us the ability to get a bulk discount. So we can save a little bit more money there. And when we fall under budget on these, which we have on all of our projects, we've fallen under budget, we've had extra money left over, that puts us in a position where if we have a 200 space mobile home park and we had a little bit of extra money left over, we could have $250,000 left over, maybe less, maybe more. We could go out and buy a small mobile home park to add to that 200 space portfolio. And then we could crank it up to a 210 space portfolio and increase the cash flow, increase the occupancy, increase the net operating income, increase the value of the property, and increase investor returns. So that's a little trick that we add on the end if we have any leftover construction costs. Buying bulk materials in advance, I covered on that. Here's what else we do with our construction. We double our construction timelines. Now, we feel pretty confident that we can execute on our timelines, but we double our timelines because there could be some unknown things that could happen. I mean, just look at what's been happening in recent years. A few unknown things have been coming up. I suppose a few shocking things have happened to the system. Now, we are projecting that our refinances are happening 12 to 36 months through the business cycle. So if we say, for example, in an investment that we bring to the table, if we project in our returns and say that we are going to do a refinance 36 months into the business plan, so 3 years after we've closed on the property, then what we're actually saying to you is we believe that we could implement our construction and get to 100% occupancy and fulfill our business plan in half that time. And so that would be 18 months. Okay. And we actually have a really solid track record of being able to fall about half or even under half of our construction timelines. But we don't know what's going to happen. We don't know if there's going to be some more supply chain issues or lockdowns or other things like this. So we build in double construction timelines. What does that mean for you, the investor? It means that if we're projecting to return capital, we're going to do that quicker in most likelihood. And also, it would mean that the returns would be higher because you're getting your money back quicker, and we're executing on the business plan a lot quicker than anticipated. But we like to have extremely conservative underwriting because we really, really want to build in for recession resistance. We want to be able to handle an environment where everything that could go wrong does go wrong, and we still not only make it through, but we thrive through that environment. So we also have our in-house construction crews to handle the remodels. So currently right now, as of this recording, we're running about 6 crews. That could expand even up to 20 crews, depending on the capacity of projects that we have, or it might contract to 1 to 3 crews, depending on how many projects we have going on at a time. But we've been working with our construction crews for years and years, and that mitigates a lot of the unemployment issues and staffing issues and contractor overscheduling. And the contracting world is a pretty interesting space right now. It's almost like contractors have pick of whatever opportunities they want to take, because there's a very diminishing amount of contractors. There's a lot of baby boomers that are retiring. There's not many millennials or younger generations coming in to replace those construction baby boomers that are retiring. So construction's in high demand right now. So we have our in-house crews to be able to mitigate against that, so we can get the job done. So we're not waiting on outside contractor scheduling. We keep our crews busy. They move from park to park. I want to go back super quick. I said that we're prepared for everything to go wrong, but we're certainly not expecting everything to go wrong. I wanted to clarify that, clean that up, because we are prepared for the worst, but we actually expect for the best. And again, we've got a 100% track record of exceeding our projections on all of our mobile home park and self-storage investments. And another thing that we do here is we double our property taxes. Now, we haven't, as of this recording, seen property taxes increase just yet. But over recent years, we've seen a lot of money printing, quantitative easing, whatever you want to call it. Someone has to pay that back. It's going to be the general public that they're going to push it on in form of taxation. Taxation comes in form of price inflation. It's actually a taxation. Also, other types of taxes like capital gains taxes, property taxes, any types of taxes, that's where they're likely going to hit us. So even though it hasn't happened yet, we're already anticipating that we can handle double what current property taxes are, just in case they get increased in the coming years or in our business plan. Also, we project our returns with 0 to 5% annual rent increases. Now, as of this recording, we can actually increase rents in the mobile home park space about 20 to 25% year on year, and that's increasing. We can only actually anticipate that going up. But if something happens during the business plan and that gets suspended and it comes back down to what has been the average prior to 2019, the average was about 5 to 10% annual increase. So we underwrite with the conservative 0 to 5% on rent raises, because if something astronomical happens economically through our business hold period, we want to know that we can handle our business plan without large rental increases. Maybe even something could happen like rent controls could be implemented in the future during our business plan. And we want to know that we can not only weather the storm, but thrive through those scenarios. In actual reality, we're still increasing our rents 20 to 25% right now, because that's where they're at. And we will continue to raise to market as time unfolds, but we're there to handle the worst case scenario. And I mentioned this before, we've got a 100% track record of exceeding our projections. So minimal fees to maximize returns. Again, we're performance-based. We don't have many fees because we're all about cash flow and equity and making our money from the performance of the deal, as opposed to all of these fees and junk fees that get thrown in there. So here's the minimal fees that we charge. We charge a 2% acquisition fee, and that's 2% of the purchase price. That's the acquisition fee, and that gets paid at closing. And that's for us to go out there and find the deal, put the deal together, do all of the due diligence, get the loan together, the whole kit and caboodle, bring investors in. And so all we take is a mere 2% of the purchase price as an acquisition fee. That gets paid at closing. Another thing that gets paid at closing is we have a 1% of loan amount. We receive that as a loan signing fee. So in a lot of cases, myself, sometimes one of my partners will come in as well, but really we're going on the loans, and I'm personally guaranteeing some of these loans. Some of them are non-recourse, some of them are recourse. But at the acquisition and the refinance, I'm bringing my balance sheet to the table and often personally guaranteeing. And so we just take a 1% of the loan amount loan signing fee, either at the acquisition loan or the refinance, and that's paid at the time of the loan closing. The only two other fees that we charge is 5% of gross revenue for property management. That's offsite property management, and 2% of gross revenue for the asset management fee. So collectively, really, this is making sure that the operations are running smoothly. This is asset management and property management. We do all of that in-house. Nobody's going to manage our properties as well as we do. Nobody's even going to execute on the construction as well as we do. And so we just charge a small fee there. We don't really make much profits on that, to be honest with you. This is really just keeping the lights on. We've got a whole bunch of staffing and expenses behind the scenes. So really, this just allows us to keep the momentum flowing until we get to the point of where we actually get to claim on cash flow and equity. And that, to be honest, is where we make our money in these deals. And that's where we believe it should be, because we're performance-based investors. So now a little bit of a chance to meet the team. So I'm Bryce Robertson. I'm the growth manager. I take care of all of the high-level decision-making, overseeing all operations, and also cultivating relationships and growth and expansion of Cultiv8 Collective. Then we've got Nolan Freeland, my business partner. He takes care of the day-to-day operations and manages the managers that work for us amongst our collective operations of property management, asset management. He also helps out on the acquisition side as well, and also overseeing like investor relations and things like this as well. Next, we've got Nikki DeYoung. She's our lead mobile home park self-storage manager. She is an exceptional sales machine. She's an excellent trainer. She's a phenomenal problem solver. She's been working with us for years and years and years. We love working together. She really is personally engaged in the entire process. We absolutely love working together, and we work together really strongly as a team. And then we've got Megan DeYoung, who is the construction manager. Megan heads up our construction crews. She actually oversees the day-to-day operations for our business plan implementation for all of our in-house construction crews. And collectively, these guys get the best discounts, solve a lot of problems, and really, really understand the holistic investment model and what we're trying to achieve here. And so collectively, we're the top main team that you would probably hear of or need to know about. We've got a lot of people behind the scenes as well, but here's the key players right here. We'll also just want to introduce you to our support team. I've quickly spoken about Cultiv8 Collective. That's our vertically integrated property management company. We do that in-house because nobody's going to manage our properties as well as we do. Cultiv8 Collective, our vertically integrated asset management company. That's our assets under management brand, also that we're presenting this webinar to you today. And also you would be joining the Cultiv8 Collective inner circle should you feel that there's a harmony and synergy amongst us and that you feel that we can help you achieve your goals financially and with freedom. Also, we have Provision on our team. That's our tax advising and accounting firm. Absolutely amazing. They work in our cost segregation studies into our tax returns so that we can get those awesome tax benefits. And they also help us strategize on exits and a lot of other complexities in the investing space. We also work with Robinson and Franzman. They're our legal team on the syndication and closing attorney side. So they bring a lot of wealth and knowledge to the table, and we really love working with those guys. And then we also work with the MHP lawyer. That's for the legal side of our transactional and real estate legal complexities. And these guys here, these firms here, they're all investors themselves. So they really, really get the game. And also the MHP lawyer, they're actually mobile home park investors as well. Although primarily they are attorneys, but they also invest in the mobile home park space as principals. So they really, really, really get the game and they know all the inner workings. So we feel like we have a really, really strong support team. Our support team goes way beyond this, but this is just the main key players that we wanted to introduce to you. Here is our geographic footprint. So as of the time of this recording, if you're looking at the light green colors here, these light green colors are our current investments, and these dark or kind of like medium blue, bluey green colors are the previous investments that we've gone full cycle on. So depending on when you're actually watching this webinar, maybe be recorded in the past, and we're expecting that this footprint will actually be a lot expanded. So what I would suggest is to get the most recent update. We try and update this as often as we can. Go to investcultiv8.com, which is our website. Go to the investment page, and you will actually find that the most up-to-date geographical footprint should be there. We try and update that every few months. So if it's not fully updated, it'll be at least pretty close within the last few months. So we definitely are expanding our footprint. So that's investcultiv8.com, and cultivate is spelt with the number 8. So that's CULTIV. So investcultiv8, the number 8.com, and you go to the investments page, and you can check out our geographical footprint. As you can see, we're mainly in the Southeast here. We really, really like the Southeast. It's some of the best markets that we have for mobile home parks and self-storage. But this is also, taking into consideration the investments that we have with our joint venture partners. So this is the smorgasbord of recession-resistant investments. So we're kind of spread out a little bit over the states. Now, our unique advantage, I'm just going to recap on this because we've already spoken about this in pretty good detail. So we've got in-house property management company, in-house asset management company, in-house construction crews. We've got over 25 years experience in construction and construction management. We buy 50% occupied properties, mobile home park and self-storage, and increase them to 100% in an extremely timely manner. We take on projects that other operators won't or can't manage. We truly have recession-resistant underwriting with ultra-conservative metrics. And collectively, this gives us a unique position in the market and a strong advantage during a recessionary environment. Here's a couple of investment examples. You can also see these on our website as well. Sierra Sands Mobile Home Community. This was the first mobile home park that I purchased back in 2015. 38 space mobile home park with a 3-bed single family home, office, laundry, storage building. It was a two-star community when I bought it. Accredited and non-accredited investors joined that investment. It was a $570,000 purchase price, which represented a 12% cap rate. Which even back in 2015 was good for them, especially in Southern California. And I negotiated a private loan of 9% interest only. Trash was paid by the park at the time when we purchased it, and we projected an annual return of 25% cash flow and equity to investors for the life cycle. That's what we projected. The business strategy was to raise rents to markets, fill all vacant homes, convert all home renters to homeowners, increase curb appeal and star rating, increase gas and electric meters, bill back all of utilities to residents, develop vacant lots, repave the roads, and it was a projected 5-year hold. But this is what actually happened since takeover. We raised the rents from $280 to $355. which represented 18.4 cap based off the purchase price. All vacant homes were filled. We developed 6 lots ready for homes. Gas and electric meters were installed at each lot. We built back the trash 100%. Roads had been fully repaved. We increased from 2-star to 2.75 stars. That's out of a 5-star rating, which we use in the mobile home park space. And we sold it for $1.3 million. It was like 4.3 years later. So that ended up presenting a 57.14% annual return distributed to our investors. And that was obviously significantly above our projections, which is 25%. Next deal example, Marshfield Mobile Home Community. It's a 200 space mobile home community. It was a 3-star community when purchased it. Accredited and non-accredited investors joined that investment. $3 million purchase price, which represented an 8.7% cap rate, while the market was at 7% at that time. Acquired a CMBS loan with a 5-year balloon. And at the time of purchase, there was a 50% water and sewer recapture. A 7% preferred return hurdle was in the deal structure with a 70-30 split. And we projected an annual return of 22.2% cash flow and equity, and a projected IRR of 19.25%. The business strategy was new management by our vertically integrated property management company, fill vacant homes and prep and fill vacant lots, converted all renters to home ownership. We strictly enforce no pay, no stay rules. Increase gradually over 5 years from $261 to market. To implement 100% bill back of water and sewer, and a 5-year hold and then sell or refi. So that was the business strategy. What actually happened since takeover? We raised the rents from $261 to $320, which represented a 12.2% cap rate based off the purchase price. All delinquent tenants were removed. All vacant homes in 11 vacant lots were filled. 20 park-owned homes had been remodeled, over 20 park-owned homes. Digital meters had been installed and allowed full water and sewer bill back. Infrastructure was improved as needed, mainly the water and sewer lines and also the electrical pedestals. We had outstanding on-site management. This was actually when we met our current lead mobile home park manager. And we've been with her ever since. Our market cap rates dropped to the 6 to 7 range, and we sold for $5.75 million. I think this was 3.5 years after the business, into the business plan. So we ended up selling it a little bit early there for significantly more than we thought we were going to or projected to, which also exceeded projections and returns from cash flow, IRR, and everything. And we got our money back much sooner to investors as well, so they could go and reinvest it in another deal. The third investment example and the final investment example is one of our automatic teller machine funds, Fund D. Fund D opened in 2019. It's ATM fund managed by Prestige, one of the top ATM fund managers in the country. At the time, they were the 5th top. Now they're actually the 4th top ATM operator in the US. It was all cash, no leverage. Accredited investors only. Third-party verification was required. Projected cash-on-cash return of 23.3%. Projected IRR of 16.5%. The business strategy was that each 104K invested represents 6 ATM machines. And those ATMs were actually, that investment was backed by the physical ATMs. 4-month ATM preparation period to wrap machines with marketing, banners, add the digital screens and topper, and then place the machine in the desired location, and then begin investor monthly distributions. The monthly distributions were projected at 23.3% annualized, and 5-year straight line depreciation, and a projected 7-year investment term. So since takeover, and this investment is still going. And 2019 was when we opened up this fund. Since then, all distributions have been paid on time, on schedule, 23.3% cash on cash return, and the 5-year straight line depreciation had been awarded as well. So this has just been paid like clockwork every month since that 4-month period lag time in the beginning started. It's been paid on time, every time, to the cent, every month. So let's talk next steps, and then we'll wrap it up here. So next steps are, number one, you should have watched this webinar, right? So create an investor profile in our investment portal. So you should be able to click on this link here, but if you can't, you can reach out to Nolan and Regine. I'm going to have their contact information here in a little bit. You need to make sure that you've created an investor profile in our investment portal, because that's where we display and manage our investments from. That's where you would actually join our investments. That's where you would receive reporting, update your bank account information, everything like that. So step number one is to create an investor profile in our Cultiv8 Collective investment portal. Then second step is to watch this webinar in entirety. Then the third step is to schedule an investor introduction call with someone on our team. That you should have already scheduled that call. That probably would have happened when you received the opportunity to watch this webinar. But if you haven't, you can reach out to Nolan or Regine, and you can actually schedule an introduction call with our team. That's where we're going to ask you some questions about you as your history as an investor. And we're going to answer any questions you got, and then we'll just talk about next steps of joining the inner circle. Also, the last step there is to complete our pre-questionnaire. So this is a document that our syndication attorney requires that we have all of our investors complete once before they join our inner circle. And so that questionnaire also should have been available at the time when you booked the introductory call. And I believe there's another opportunity later on in the process with us, but we have to have that pre-questionnaire completed and sent over to us and approved for us to be able to give you full access in the investment portal. And at that point, you would actually be a Cultiv8 Collective Inner Circle member, where you would have access to our off-market recession-resistant investments in our investment portal. And you would also be part of our communication moving forward by emails. So upon completion of these 4 steps, you will be Cultiv8 Collective Inner Circle member. So what to expect as a Cultiv8 Collective Inner Circle member? So in the inner circle, we give weekly email updates. We used to do it monthly, but it was too much to send out in 1 month. So about every week, you're going to receive an email update. There's going to be a topic of the month 1 week. The next week, there's going to be our investment pipeline, which is all of the deals that we're working on that we think we're going to bring to the table in the near future. That helps you pre-plan and understand what investments we have coming soon. Not all of those investments come to fruition, but most of them do. And then the next week, you're going to receive an update on all of the investments that our inner circle are invested in, or like a monthly update on the progress of each of those investments. And then on the 4th week, we're going to throw in a little bit more value and content, and you'll have access to a lot of webinars and podcasts and live events and all of these sorts of things, because I'm out there in the media and creating a lot of content. And I believe that, knowledge is very powerful to our investing decisions. And so we throw a lot of educational resources out there as well to help you guys out. You'll also be part of our deal launch emails. Typically, when an email goes out, it'll be email about deal coming soon, deal coming next week, deal coming tomorrow, deal live, and then maybe 1 or 2 more emails. And we do that for each investment. There's also many free educational resources, tons of free educational resources. And for any of the resources that are paid tuition, we offer 50% off to our Inner Circle members. That's off live events and courses, typically 50% off for our Cultiv8 Collective Inner Circle members. You'll have access to a smorgasbord of recession-resistant investments. You can access our investment portal here. You can click on this link here. And if that link doesn't work, then you can reach out to Nolan and Gene to access our investment portal. This next point, I really want to just dwell on this very quickly here, but very importantly, we work on a first come, first served basis. And our investments have been in extremely, extremely high demand. So the reason I'm mentioning this is because as soon as you get that deal live investment email, or if you've requested to be on our shortlist and you get the text message that says, hey, the deal is live, immediately stop what you're doing, log on to the investment portal, and for that particular investment, reserve your desired investment amount, because we come on a first come, first serve investment base. So it goes in order of those who reserve their investment amount. And you're doing that to secure your position. Don't worry, you still have 3 to 4 weeks to review the investment, watch the investment webinar, check out the investment summary, get any of your questions answered by our team, sign the documents and fund. You'll still have 3 to 4 weeks to do that. But if you don't reserve your investment position immediately, a lot of our investments have been oversubscribing in 24 hours, some of them in only a couple of hours. So make sure to get in there and reserve your position quickly. We do a really, really good job at sending out communication to let you know when we're going live. So you should be very, very well prepared to go out there and secure your position. Typically, investors still have 3 to 4 weeks to review, sign, and fund. I just mentioned that after you reserve your position. Minimum investments are typically $50,000. Access to our team. That's what you get. You get access to our team to get the support you need. So if you have questions, if you're having any challenges, if you need help with something, if you need us to walk you through anything, our support team is there to help you. You get access to us. We're there for you. And we also throw in, a handful of free gifts and additional perks along the way, as long as your journey as an investor with us, because we truly want you guys to have an excellent investor experience here with Cultiv8 Collective. So if you guys have got any questions, you should have been writing them down. Make sure to write them down. And then when you schedule your call, make sure to bring them up on your investor introductory call. Here's support right here. Nolan Freeland, he's my business partner and principal at Cultiv8 Collective, and Regine as well. She's your concierge here at Cultiv8 Collective. So if you email these guys, if you need anything, and they'll put you in the right direction. They'll either help you personally or they'll connect you with somebody on our team that's going to be able to help you. So if you're looking to get access to our investment portal, if you haven't received the questionnaire, if you're looking to schedule a call and you haven't done that yet, reach out to these guys. They'll get you hooked up. And then once you're part of the inner circle, you can reach out to them if you need anything. So I just want to take a moment to thank you very much. I know you've taken the time out of your day. I know your time is very precious and valuable. I hope you've got a lot of value out of this. And if you feel truly synergized and harmonized and you would like to join the inner circle, then we're super, super excited to have you join us. And we can't wait to give you the best investor experience. Thank you very much. I'm Bryce Robertson. And again, we're super excited to have you join the Cultiv8 Collective Inner Circle.